So we had some questions come in last week that related to the married put position. Mike E. had asked, is there a reason that ETFs do not appear in the standard married put search? Mike also continued on with, I have 100 shares of GS at 350, cost down to 320 after other adjustments and covered call positions. GS is around 285. How can I use a married put strategy? And a similar question came in from Marco. If I have unrealized losses on a stock, does it make sense to use a married put to limit losses? Well, the first part is easy. In the blueprint, we discuss the preferred stock criteria we use for a married put position. We typically look against a preferred stock list. We look for stocks that have a volatility of greater than 0.25 or 25%. We want some movement on the positions. We want stocks that reflect good growth. We look for an earnings per share growth of greater than 5%. And the stock price is limited to be between $9 and $200 per share. Now, an ETF won't be in that preferred stock list. In normal market conditions, they have a volatility lower than 0.25. Of course, we're talking about SPY, QQQ, IWM. And they don't really have a registered percent earnings per share growth. But as with any strategy criteria on PowerOptions, these can be changed to find the positions that you feel bullish on, as the married put approach is a bullish strategy. The married put will work with any security that does move up in price, even inverse ETFs, a potential play for a bear market. Changing criteria. When you go into PowerOptions, you go into the married put search, and likely the radioactive default search will appear. We want to go into the technicals tab, and we're going to change the historical volatility value to a more reasonable level for a broad-based ETF. We still want to look for a volatility of maybe greater than 0.10 or 0.15, 10 or 15% for some movement. Now, with recent market conditions that we've seen in 2022, most of the general ETFs do have a volatility of greater than 0.25 at this time. However, there are other things that we need to change. Next, we're going to go into the Fundamentals tab on the PowerOptions search. We're going to change the stock price range to allow for higher priced ETFs, maybe up to 500, maybe up to 750, depending on which ones you're attempting to target. And we want to remove the percent earnings per share growth. Now, in the lists field on the search, we want to remove the IBD list that's listed there, and we want to change the stock list to include indexes and ETFs. We also are likely going to exclude inverse and leveraged ETFs if we're just looking for standard ETF positions for a married put protective play. Of course, if you wanted to screen specifically for inverse or leveraged ETFs, you would enter that inverse and leveraged ETF list into the include field to screen just against those. Making those changes, what do we get? Well, we get some ETFs here, China ETFs, global lithium and battery tech, and things of that nature. But where are the main ones? Where's SPY, QQQ, gold or silver, semiconductors? None of those ETFs are here. In the default search, we are also looking for stocks that are trading above their 50-day moving average. You have to take that into account, as most of the ETFs you might be screening for are currently not in an uptrend. So we'll go back into the technicals, and we're going to remove the simple moving average. Instead of stock price greater than SMA 50, we're just going to change it to none versus none. And now we get a much more recognizable list. Now, initially when I ran this search, about 600 results appeared. So I increased the stock price a little bit higher to be 140 to 500 to filter out some of the lower priced ETFs. But here we do see we have DIA, IWM, QQQ, SPY, several Vanguard ones as well. More of a recognizable list of ETFs with the risk control that we want in about the 4 to 4.5% range. So to recap, start with the default radioactive search sorted by earnings per share growth. Under the technicals, lower the historical volatility level, remove the SMA requirement. Under the fundamentals, increase the upper stock price range and remove the filter for percent earnings per share growth. Under the lists, change the stock list to indexes and ETFs and potentially exclude leveraged and inverse ETFs as well. Another approach, if you just wanted to see married put positions or even covered calls in another strategy on just 4 or 5 basic ETFs that you're focused on, simply go into the list field, click on Create/Modify Stock Lists, and create a list of the ETFs you were interested in. Remove all the stock technical and fundamental criteria for the default screen, but leave the options criteria there. Looking for puts that are at least 150 days out in time, have the controlled risk of under your preferred range, 7.5%, and of course not going more than 20% of the money, which you won't have an issue with to get a controlled risk with these ETFs. Then you can select to include that list you just created and screen with the option criteria you'd want for the married put approach following the rules in the blueprint against those preferred 4, 5, or 6 bucket of stocks. Question number 2, a little bit more involved. Remember for Mike E., we have 100 shares of GS at $350, cost is down to $320, GS is around $285. How can I use a married put strategy? And similar for Marco, if I have unrealized losses on a stock, does it make sense to use a married put to limit losses? My answer to Marco and to Mike E. directly via email. A married put added to a declined stock will help mitigate some further losses if the stock continues to decline. However, we have to realize that this structure does not repair the initial loss, and we will still need an upside move to get back to break even. If I had bought stock at 100 and it fell to 70, well, we've got a $30 loss on the stock. If I buy a 75 strike put for $9, it's 150, 200 days out in time, I still have a total cost in the position of $109. But I am now guaranteed to get 75 back in the worst case scenario. This is still a $34 loss, or 34% on the trade, if the stock remains below 75 at the expiration date, assuming I use no other income methods, adjustments, and accept no dividends. I locked in the unrealized loss of 30 and still have to make that back, and added the $4 of time value on my purchased put to the total monetary risk. I still paid into that extra time premium, and we still have a $25 loss there between the 100 cost basis and the 75 we're guaranteed to get back. That creation of a married put on a declined stock would prevent further monetary loss if the stock dropped to 60 or 50 or lower, but it would not immediately repair the position without further income methods and adjustments. But let's take a look at that GS example specifically for Mike E. Bought 100 shares of GS at $350, and after some covered calls, cost basis is down to $320. At close of business on June 23rd, GS is currently at $286.17. So again, we're roughly looking at that loss at that time of about $34. Steps to use. On PowerOptions, I'd go into Married Put and I'd click on the Insurance tool. I just put in the basic information, stock symbol, my cost per share, and then I'd select an expiration date that's at least 150, 170 days out in time, following the rules in the blueprint. In this case, and sometimes this happens, the stock has fallen too far for the Insurance tool to see what risks we would have by adding new puts to the position. So we see here, no results are found. Our cost basis is too high. But no worries. We're simply going to go into the Married Put tab again and go to the Search by Symbol tool, put in the stock symbol and our desired expiration date to evaluate which Married Put structure would look best to us if we were opening a new position on GS today. And so here we see some of the results for the January series. Current risk, if we did buy the stock at 286 and purchased the 300, 305, and 310 put, for example, we have risks of about 7% to about 5.5% being slightly in the money, the approach we'd want to use following the rules in the blueprint. Now, how to evaluate which strike is best for you? Well, we've talked about this before in other webinars, sort of evaluating the three bears. If when I open an initial married put, I don't want to take a risk of more than, say, 7% or 7.5%, I want to be slightly in the money, but I'm going to look at the three positions, starting with the highest risk and the two below. So if my preference is not to take a risk of greater than 7% when I open a new married put, in other words, adding 7% of time premium to the position, I'd start evaluating the 300 strike, the 305, and the 310. And in most of these cases, what we usually discuss is when I'm evaluating a new position, depending on my outlook for the stock, the three bears, not too high of a risk, not too deep in the money, and too low of a risk, but right in the middle. So I might target the 305 position. However, this is also dependent when selecting a new married put of where I think the stock is likely to trade in the next 20 to 40 days. That's when the best time would be to apply one of the bullish income methods of the 12 different income methods discussed in the blueprint. So if I have a feeling that the stock might reach up to 300 in the next 20 to 40 days, maybe I do take that higher risk with the 300. But if the stock reached 300, I'd still be able to do really good adjustments following the rules in the blueprint if I had the 305 put or even the 310. Another thing you might want to consider based on your position, your decline on the stock, is how much more premium you're willing to put into the position versus the risk. January 300 put has a midpoint of 35.65. That's still about 11% of my cost basis of 320. The 305 midpoint at 37.98 is a little bit higher percentage-wise against the total cost basis I have at 320. So if you only wanted to add 5 or 10%, you'd be buying a cheaper put, but you wouldn't get the best protection. My preference in this case is to still follow the same rules of opening a new married put, going slightly in the money, and targeting the risk that I'm comfortable with, knowing that I'm still potentially locking in the unrealized loss I have on the trade. But we do have to remember that 6.9, 6.1, and 5.5% risk is based on today's price of $286. That is not our price. From the Search by Symbol tool, we'll use the Edit More Information button to link to the profit and loss chart, and we'll change the stock price entry from the 286 to our price of 320 with buying the 305 January put for 37.98. And now we see our true risk. Our total investment is now $35,798. That is also our new break even. If and only if we hold the stock and this married put position all the way to January expiration, make no adjustments on the trade, and accept no dividends, and the stock is still below 305. That's the only time we'd still realize the maximum loss. We do have a new maximum loss now of $5,298 or 14.8%. That's the combination of the time value of the put, which was $19.15, that's 6.1% at risk, with our unrealized loss sort of locked in of that $33.83 roughly. So we know we have a 14.8% risk. We're down currently about 10.8, 10.7% on the position from our cost basis of 320 to 286. So we've only added about a 5% risk to the trade if GS continues to go down further. Now, what did that do? Did that really help the position? Is converting a declined stock into a married put now an instant repair? No. It caps the risk for further uncertainty, but does not get the position back to break even. Do we control further losses if the stock continues to move down? Absolutely. We have an unrealized 10.6, 10.7% loss on the position. If GS falls another 15%, we'd be looking at an unrealized loss of around 25% on just the stock position. With the put added, the worst case scenario is we could lose 14.8%, even if the stock fell another 10, 14, 20, 25% on the position. Now, you may be trying to repair this decline stock by just selling calls against the position, trying to cut down the cost basis, as Mike E did before, taking his cost basis down from 350 to 320. Can we also do calls, other adjustments in the new married put structure as we could just owning the stock? Absolutely, including the ability now to manipulate the put option as a second asset. There are 4 different ways discussed in the blueprint that you can use the put option to adjust the position, lower the cost basis potentially, lower the risk as well, and put yourself in a better situation. So if we did that, now what? Well, remember, the married put approach we discuss in the blueprint is not just putting on a protective trade and hoping it goes up. Yes, we're looking for bullish positions, and yes, we have a bullish expectation, but we don't just put the position on, leave it alone for 6 months, then come back and say, oh, do I have a profit? We're going to actively be applying the adjustments and the 12 different income methods discussed in the blueprint to lower cost, lower risk, and potentially increase the profits. There may not be an income method now that I've added the put to the declined stock, but it will become available as the stock starts to move up in price. Do I expect the stock to move up? Well, I'm not giving advice directly on GS, but the question that came in is, on a declined stock that I'm holding, is it a good idea to add a married put position? Well, if you're still holding the stock and Mikey is looking for ways to adjust it, that tells me that he expects the stock to recover at some point, near term or farther term, doesn't want to lock in the loss that he has right now, doesn't want to close the position and take the loss, wants to look to repair it, which means he's going to stay in the position. So do we expect the stock to move up? Well, of course. Why else are we staying in the trade if we don't see any further upside for the position or potential recovery? Now, you've seen many different webinars, of course, where we've discussed other alternatives for managing a broken stock position. In today's trading, June 24th, right around 12 noon Eastern Time, GS is up to $300. It's only 20 points below Mike E's cost basis. You could still continue to sell out of the money covered calls month by month to hope to get back to break even, make up the $20 or $30 you're missing from the current price and unrealized loss. Selling a call premium is going to lower the cost basis, but it won't cover further downside. You could always average down the position, but this is risky because you might be putting more money into a bad trade, and it does also not cover further downside if there are further declines in the position. On PowerOptions, you can use the stock repair tool, a potential way to reach break even faster. Simply input your stock and simply input your cost per share, and this tries to build a ratio call spread for you that might help you get back to break even. With the stock up to $300, you now maybe have better choices for adding a married put to control risk if the market starts to pull back next week after this week's increase. In uncertain markets, can we trust 1 week of upside? Is that something that we can count on that it's going to continue to move up and get Mikey back to break even? Or do we expect more volatility over the next few or several weeks, movements up and down, where you can use the married put and the put option as a second asset to help you lower the break even, profit off of the put, or maybe adjust it even if the stock continues to move up to get a lower risk on the position and better control on the trade? A recap of our discussion. Part 1, ETFs and the married put search. Well, the ETFs won't match the initial criteria discussed in the blueprint for the married put position. But as with any search in PowerOptions, you have the flexibility to adjust the criteria for positions you're bullish on and interested in trading as a married put position or another strategy. Or you can simply create a stock list of the positions that you're looking for, keep the option criteria, and just screen against that basket of stocks. Part 2. Is it a good idea to add a married put to a declined stock? My opinion, yes, to control further losses in these uncertain markets we're seeing in 2022 and to prevent further losses if we see another unexpected downturn we weren't prepared for. But we never lie to you, we're always honest, it is not an instant repair. The steps use the insurance tool to see if any of the puts come up, which would show you your risk based on your cost basis. But if none appear, use the search by symbol tool and profit and loss chart to evaluate the positions. Then follow the guidelines in the blueprint for the proper application of the 12 different income methods moving further to generate income, lower that initial at risk, and help you get back to break even.